Hello and a very warm welcome to my Q3 2024 market update. It is hard to believe that we are already in the final quarter of calendar year 2024. Speaking with clients about Christmas plans, travel back home for the end of the year, and of course planning ahead for 2025. This quarter has certainly been a very eventful one. We started, or rather early in the quarter in early August, we saw Japanese equity markets whipsawing up, down and sideways with the yen carry trade. We saw Buffett and Berkshire Hathaway trimming some of their profitable positions in Apple, all hitting at the same time. We saw equity markets down 15%, back up 10-15%. It was quite a wild ride there in early August. And now, of course, we are heading into the US election in the not too distant future. We will eventually be heading into the Australian election over the course of the next 6 odd months. And of course, that brings with it all of the usual headlines around tax reform, property, immigration, and of course, all of the talk around negative gearing rearing its ugly head again. So in this market update, I'm going to share with you a bit of an update of what's happening around the world, what we've seen in equity markets in the different regions, where we are seeing opportunities, and of course, what it means for our investment portfolios for the remainder of 2024, and of course, the year ahead. So let's dive right into what has happened broadly at a global level, first and foremost. Now, looking around the world, if we start with the United States, we have seen the Federal Reserve cut rates, so the first meaningful cut in quite some time. The Federal Reserve cutting rates by 50 basis points or 0.5%. We saw one of the Fed board members actually dissent and effectively voting for or trying to put forward a 25 basis point cut. So a little more conservative on that easing cycle, but they did progress with the 50 basis point cut. Now, while that does mark the start of the easing cycle, what we feel is far more important is the fact that markets are actually pricing in a 100 basis point cut by the end of this calendar year. As you'll know, we've only got 3 months left of this year, not even. So naturally, that means that we're probably going to get 2 more cuts at the following 2 meetings, and that they're probably going to have to be quite substantial. So we may see a 50 basis point cut. The initial equity market sort of reaction to that first cut has been relatively subdued. I think we all kind of expected it. US unemployment has been rising steadily, inflation in free fall, economic growth relatively steady, and of course that allowed the Fed to cut rates. So all in all, a fairly positive step as we head into 2025 and of course the election. Now, it wouldn't be a market update for this time of the year if we didn't talk about the US election. Of course, we have Trump in all the headlines, and whichever way the election goes this year, it's important to note that it will be very likely an inflationary outcome. Both sides have announced that there will be tariffs, there will be spending, and whilst the Republicans are typically more, let's call it fiscally responsible, with Trump in power, it is going to be more tariffs, more spending, more tax cuts, and that is going to be inflationary for the broader economy. So what that is going to mean is that inflation may remain a bit higher. Markets are still pricing in aggressive rate cuts, so we don't think that's going to change a great deal, nor do we think there's going to be a huge need to change investment portfolios based on the outcome of the election. Now, looking more at a micro level at individual companies, we are seeing the majority of the tech sector in the US continue to outperform earnings expectations. So whilst we have seen a strong run there, particularly in the likes of companies like Nvidia, whilst earnings are beating analyst expectations, and as a result, stock price forecasts are being increased, we do believe that there is certainly an argument to remain fairly well exposed to that sector going forward. We have also seen a bit of a rally in infrastructure and industrials, and that may very well continue going forward. So we'll certainly be watching this space. We're cautiously optimistic, but certainly believe that particularly US equities have more room to run. So that's a bit of an update on what's happening in the US. Let's have a look at what is happening in European markets. Now, looking at the Eurozone, really, again, it's all eyes on interest rates. It's all eyes on inflation. The ECB, the European Central Bank, did follow the Federal Reserve's path, also cutting rates by 60 basis points as opposed to the Fed's 50. Again, European inflation has been in a major freefall when we compare that to what is happening back home in Australia. Inflation rose a lot faster. It also declined a lot faster. We actually saw inflation head into the double digits. And when we didn't see a huge increase or huge sort of geopolitical tension, I guess, concerns around energy supply last winter, and expectations are that will be more of the same this year, we have continued to see inflation decline. So we're not expecting that to really change. European equities have performed relatively well. We're not seeing huge political changes, I guess political outcomes really changing markets. We're also seeing some fairly strong growth in the small cap side of European equity markets as well. So we do feel there are some good opportunities there. Naturally, as the conflicts continue, as awful as they are from a humanitarian standpoint, and obviously this is not a political update, so I will leave that one alone. But from a market standpoint, these events, these geopolitical tensions, tend not to have a major or meaningful impact on global equity markets. So we don't foresee any need to make any changes based on what is going on in the Middle East and, of course, the region in Europe. So we do expect that interest rates will continue to be cut by the ECB. We do expect there will continue to be more and more political uncertainty, but not a huge need to change investment portfolios going forward. So let's have a look a little closer to home at what is happening on the ground right here in Asia. Now, looking at markets in Asia, of course, it would be remiss of me not to first focus on China. China has seen an incredibly strong rally over the past month. Chinese index up about 21%, largely on the back of the efforts by the CCP. We have seen the Go Big fiscal policy released, effectively driving stimulus, more and more payments, more and more incentives, encouraging first home buyers, encouraging domestic spending, really aiming to stimulate domestic growth in the Chinese economy going forward. They are really doing everything they possibly can to hit that 5% economic growth target, and we do expect that there will probably need to be more to come. In terms of our exposure to Chinese equity markets, we remain relatively cautious around anything to do with building, financials, real estate, but quite cautiously optimistic on the tech sector there. It obviously has been quite a volatile ride over the past 5, 6, 7 years, but we do expect that there are going to be some opportunities there going forward. Again, fairly light exposure based on what we're seeing at the moment. The renminbi, in terms of real effective exchange rates, it's quite bullish for exports, and naturally that will be good news for China going forward in terms of driving economic growth. Looking outside of that, in terms of emerging Asia, again, we are seeing more and more investors chasing developing emerging Asian equities. We are starting to see some reasonable growth there. Again, we remain relatively cautious. We're also seeing a similar sort of theme play out in emerging market bonds relative to the developed markets. So we do see some good opportunities there in emerging markets and Australian bonds. We'll touch on Australia shortly. But for investors going forward, we do see some good opportunities there. Now, I mentioned at the top of this market update that we saw the Japanese yen carry trade unwind in early August. Now, I have already released some content, some updates, some videos on exactly what happened there. But I guess just to give a really short update quite quickly on what transpired, the yen carry trade basically involved investors, traders, funds borrowing money in Japan because interest rates were at zero. So in some cases, investors were being paid to borrow money. They would then shift that money into a higher yielding country or currency. So markets like the United States, like Australia, where you could generate 3, 4, 5% on your cash in the bank. Now, what happened? The Bank of Japan lifted rates. And then, of course, we started to see margin calls, and all of those trades, those positions needed to be unwound very, very quickly. So that is why we saw Japanese equity markets down 15, 16% very quickly, and of course recover just as fast. So quite a wild ride there in early August. We did also see at the same time Berkshire trimming some of their positions in Apple, which of course occupied the headlines. That coupled with the volatility in Japan, and of course the media's dream come true. What a wild ride, but really didn't mean a great deal for investors. So that's a bit of an update on what's happening in Asia. Again, we do see some good opportunities in emerging Asian markets at the moment, as well as a few opportunities in Singapore and Hong Kong, but relatively sort of more subdued growth in both. Let's have a bit of a look at what is happening on the ground down in Australia. Now, of course, again, we look at the central bank in Australia, the Reserve Bank of Australia, far more stubborn than the Federal Reserve and many other central banks. They didn't lift rates as quickly as inflation took off. And of course, we're not going down as quickly either. Now, whilst I believe they probably should have cut rates at the last meeting, sadly, I do not control the Reserve Bank of Australia's decision-making. They are persistently targeting inflation, stating that we're not going to consistently achieve the targeted range of 2 to 3% until 2026. Now, personally, as I said, I think that's a little far-fetched. I think we'll be in that range far quicker. But again, we have not seen the first meaningful rate cut, and expectations are that we won't see that until Feb or March, or maybe even Q2 of next year in 2025. So we certainly need to watch this space. Equity markets in Australia have been quite resilient, particularly boosted by financials and the resource sector. With the oil price coming off, we have seen energy stocks relatively soft over that third quarter. And of course, Chinese demand remains quite front and centre for Australian equity markets, particularly if we look at the dominant forces of the resource space. That may be positive news for companies like BHP. Again, not a recommendation, but just to illustrate the point, where we have lower cost producers. So even if the iron ore price does come off, we may see some of those larger players actually benefit from that, where others actually have to start reducing supply and reducing production if we do see lower for longer iron ore prices. But again, watch this space. I mentioned earlier that we do have the Australian election coming up in the not too distant future. No date yet announced, but I'm sure that won't be too far away as we head into calendar year 2025. All the usual stories, front and centre again: housing supply, immigration, negative gearing. Not expecting too many meaningful changes there, but again, certainly will occupy the headlines for the foreseeable future. Far more importantly is the impact on the Australian dollar. So for a lot of our Australian expat clients who are sending money back to Australia, whether to buy property, to contribute to super, to pay down mortgages, pay down HECS, send the kids to school, whatever it may be, the Australian dollar has already seen quite significant strength. Now, we have been forecasting that the Aussie dollar would strengthen basically from the start of this year, and essentially whenever the Federal Reserve started cutting rates faster than the RBA. Now, we've only started to see that recently, and that is really showing up in the Aussie dollar. If we look back to early August, the Australian dollar was trading at about 65 US cents, and then by the end of September, we saw that right up at 69, and we're currently hovering at around the 68 level. So very likely, based on what we know now, that the Australian dollar did find that floor at around that 64, 65 cent level, and that we will continue to trend up from here. Now, if we look at the Sing dollar, far more important to myself and those of our clients on the ground here in Singapore, we haven't yet really seen significant strength in the Sing dollar relative to the Aussie, or vice versa, and we're still trading at around that 113, 114 level. So again, if you are thinking about shifting funds, structuring investments, adding exposure to Australian dollars, it may be quite timely to really give that some serious thought now. So that is a bit of an update on what's happening on the ground in Australia. Looking broadly at global equity markets and global investment markets as we head into the final quarter of this year, we do believe, obviously, that political uncertainty is going to remain front and centre, but opportunities certainly exist for investors, particularly in the likes of small cap equities right around the globe, emerging market bonds, even Australian bonds, which are we believe quite reasonably priced at the moment. Again, time will tell. And again, anything that is sensibly priced in terms of those global growth equities. Anything that is trading at ridiculously high multiples or with too much debt that may not be sustainable, naturally we think there will be challenges there going forward. But all things considered, we do believe it will be a fairly positive 12 months ahead. So I hope that gives you a bit of food for thought, what we're looking at, what we're thinking, how we're thinking about investment markets going forward. As I said, all eyes on central banks, interest rates, and of course, currencies as a result in terms of how we position our markets. So feel free to drop me a note with any questions you may have. If you'd like to book in a time to have a chat, please do feel free to do so. As I said, we'll be reaching out with any changes we believe we should be making. Otherwise, thank you very much for tuning in. Do remember to like, subscribe to the channel, make sure you're keeping updated with all of our timely market updates, as well as any tax updates or anything else you might need to know. But thank you again for tuning in. I'm Jarrad Brown and appreciate your time.